Welcome to the latest edition of The Bull, the Bear, and You, as we navigate what is happening with the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to use. How high is the sky? That seems to be the case with the stock market over the past month or so, as AI and tech stocks just keep pushing the market to new record highs. But is it too late to join the party? How are other sectors of the market doing, and should you be protecting yourself from a bubble that might burst? We'll have some opinions coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Frank Rossetti. Frank has his own alternative investment company, HF Management Company. Also at the table is Kim Forrest of Boca Capital Partners. And we find Jim Senegal of Fregasso Financial Advisors. Jim is a senior investment analyst for Fregasso. Now, Jim is filling in on short notice for Michael Godwin, who could not be with us. And also not being able to be with us today is Carrie Coghill. She's also a regular. I don't know if it's something I said before, but they all bailed out at the last minute. So that's what happens sometimes, I guess. Jim, thanks for joining us once again and filling in for Michael. Glad to have you with us. Not much has been happening in the markets. Unless you're into setting new highs almost half the time since the March 30 lows. The gains have been impressive, and the chip sector and tech stocks, chip sector is on fire. As an example, Micron Technology surged from market value of $500 billion to $1 trillion in just 48 days. Coupled with that are these quotes I gathered from my weekend reading and from Bloomberg. This is a quote. Investors who have spent months doubting the market frenzy find themselves underexposed. For investors who have been cautious throughout the stock's rally from the March 30 low, it's likely to become harder and harder to resist jumping in. And from the Wall Street Journal, one investment strategist said that the AI is moving forward. You don't necessarily want to try to stop it or be on the sidelines. Also from that same article, in late 1996, Federal Reserve Chairman Alan Greenspan formally warned of irrational exuberance. I think we all remember that in the stock market. Over the next 3 years, though, the NASDAQ Composite Index tripled. Again, the dot-com bubble didn't burst until 3 years after his warning. So all of this leads to this discussion, I hope. Is it too late to join the party? How are other sectors in the market doing? And should you be looking to try to protect yourself from a bursting bubble that could be coming? So let us begin with this. Is it too late to join the party? Jim, you're our guest. I'll start with you.
Yeah, I don't know if you've ever arrived to a party late, but if you do arrive late, one thing you don't want to do is try to catch up to the people that have been there since the beginning. So I think you definitely don't want to try to catch things now. It does have a little bit of a late 90s feel. The nice thing is, as well as tech has been doing, there are other sectors of the market that are benefiting from this boom, including the old economy, energy, industrials, materials. Those sectors are also doing well. And even within tech, we've seen a little bit of a bifurcation. All of the AI beneficiaries are skyrocketing, but a lot of the tech companies that are seen as maybe at risk from AI, software in particular, those have become value stocks, whereas really those were the hot growth names a few years ago. So I think there's something to be said on both sides. I don't think this kind of gold rush is over. As long as we see the scaling continue in AI, that the more money you put in, the better the capabilities. I think this is going to go on for a while, but it's definitely something where you don't want to try to catch up now to something that's been going on for a couple of years, especially when you see activity like today, where we have multiple tech stocks up 20% or more. It does feel a little exuberant.
Kim, your thoughts?
Well, I will have to admit this. My portfolios that I run are the beneficiary of this. And I'm not some sort of guru genius. Not completely, but I didn't chase after NVIDIA. But I've owned a lot of these names forever because I saw value in them. And boy, has that caught up. Now, what do? I actually keep selling these because, you can't have too much exposure to the winners. You just can't. I mean, God knows I love winning. Everybody loves winning. But that's how you kind of, limit your risk. Now, if you're not in the party, this is how I kind of catch up, right? Is I decide, is this a real thing or not? We'll get to that in a second. And then I take maybe half a position, and I always wait for a day when whatever area or stock that's in question has pulled back. And so I'm not trying to throw everything I have at this. So those are my kind of guidelines for when you feel out of step with the rest of the market. Now, I think something I'd like to talk about, and maybe you can say, can we put this later in the show, is the thing that everybody's asking is AI real? Because that's the question. Every time one of these stocks that are hot comes up to the earnings call, people want to see, what are those orders? Is this for real? Is this continuing? And it looks at this point, yes, it is. But I would say, and my old software hat now goes on, where I worked at an AI company or a couple of AI companies, it's never, ever going to play out how you think. And we've already seen that. In the beginning of this thing, we thought it was only NVIDIA that was going to win, and then OpenAI. And now it looks like Anthropic is the winner, and maybe Google a little bit. But it's going to change. We are extremely early in these innings. The other thing I have to say is, everybody blames the downfall of the market in 2000 and 2001 on .coms, and it was not solely that. There was a lot of very heavy spending in tech from telecom. There was a change in telecom rules, too nerdy to talk about here in depth, but that created a whole lot of spending in telecom, so that's tech. And then there was the Y2K thing, and that, caused a whole lot of spending in all kind of business software. A lot of the analysts thought that spending was going to go on even once, the Y2K problem was taken care of. And then there's finally the .coms. And guess what? The .coms work. Like, it took longer for them to roll out. And I think that's the example I want you to leave you with this, is AI is going to take longer to roll out. The original winners are probably nowhere to be seen in the .com world. And maybe that'll happen in the AI world. But really, this time is different because we don't have these two other things that are leading this buildup.
What we do have, though, is we have old economy things like infrastructure bills where they're fixing roads and bridges. We have the need for expanding our grid to handle the power needs of the AI thing. We have the decimation of our military stockpile that has to be recreated. We have the never-ending expansion of the medical industry, which will create, we created a whole new weight loss situation that people are spending gobs of money to become svelte and or get rid of diabetes, probably a more admirable goal. But all these things are happening, and all of these things together tell me that although the market might be a little ahead of itself, the long-term thing is it's going to grow. And it takes a long time for our manufacturing to be recreated in order to generate all this stuff, because we've allowed it to go and to decline. And we've now created a trading problem in the world because we've decided we should do everything here. And so there's some logistic problems that are being created, not to mention a war that created a huge logistics problem. And that doesn't look like it's going to be solved anytime soon. So all that being said, there's a lot of positives out there, but there are innumerable potholes that have to be engineered around to get things going. And as we come upon those potholes, opportunities are going to be created.
All right, this is a little off topic, but since you kind of brought it up, the AI companies such as Anthropic are going to be IPOs. The other one, what is it?
OpenAI.
OpenAI, an IPO.
And don't forget SpaceX.
SpaceX. Okay. As an investor, is that when they come on the market? the New York Stock Exchange or the NASDAQ, whatever it might be, is it a good idea to invest in those at that time, or has the money already been made by the private equity that funded these things to start with?
Let me start with the whole point of the markets is to generate capital for things just like this. It isn't about trading and investing. It's about capital markets to create capital so that new industries can evolve. That being said, the purpose of underwriters is to properly price this stuff. The underwriting community has failed miserably at doing that because they bring them out at 20 and 5 minutes later they're 200. And I'm exaggerating, which means they didn't price it right to begin with. And that being said, the other thing that I've said for the 52 years I was in the business, if I can get the new issue, you don't want it. Okay? And these things will not be available to everyday investors. The institutions will suck them up. Their buddies will get it. And then they'll quickly flip it, which when we did new issues back in the 70s, we didn't want people flipping the stock very quickly. We wanted them to hold it. We wanted investors in there, not traders, whatever they're called. I don't even know what to call those, the people that get it and flip it. And I'll never
Jim, your
forget-
thought.
and I'll
Jim, your
never
thought, since you're a senior investment analyst.
Yeah, obviously the valuation on these companies looks extreme right now. And I think one of the things to remember is that we don't know how this is going to pan out, the AI kind of story going forward. If it turns out that it is a winner-take-all market, one of these companies, whether it's Anthropic, Google, OpenAI, if they are the first to develop artificial general intelligence, they take a vast majority of the economic value in the U.S. Obviously, you're going to want to be in that company. However, if all of these models continue to work similarly, it becomes essentially a capital-intensive commodity industry. They could all end up being losers. So I think there's a little bit of risk on both sides. I think we tend to be a little more focused here on downside risk. What happens if these performance curves flatten out, if we don't get to that level of intelligence, if AI becomes a commodity, which it kind of is right now. A lot of these companies are very similar in terms of capability. So we're just a little more focused on the downside risk of losing a lot of money in one of these highly valued companies than missing out if one of them does become extremely successful. There's a lot of companies that fell by the wayside for every one Amazon, NVIDIA, and I think that's important to remember.
There's also a more practical way to look at this, and this is on any spin out of a company. Whenever one company that you might own, decides to take a chunk of it and make a standalone company, that's called a spin out, spin off, or an IPO. I always like to wait a good long time in either one of these to buy them because, well, there's people running these companies that don't know how to talk to Wall Street. And they have big aspirations. Like everybody thinks, OpenAI, SpaceX, whatever, they're going to rule the world. Well, here's what happens. They have to decide how they're going to tell their story. Right now, they've only been telling it to people who were looking for this great exit strategy, maybe. And now they have to talk to regular shareholders and set reasonable, aspirations. It takes about 18 months for new management that has never talked to Wall Street to be able to set that tone just right, to be able to manage expectations. So you're going to go on a wild roller coaster, even if you do get shares, given to you to be able to buy at the IPO price, or if you take the big chance and then buy it on that day where it's going up, 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 right? So buyer beware. This is a young company that doesn't know how to talk to Wall Street, and you're going to go on a roller coaster ride.
That's a great point. We saw that even with Facebook and their spending on the metaverse, where investors eventually made Zuckerberg and the company backtrack on their metaverse spending plans because maybe the general public wasn't as ambitious as he was in terms of where virtual reality was going.
And he's one of the people that have the least experience in AI and least use case, and yet he's spending again. So God bless you, Facebook owners.
And
Meta, sorry.
For people who have run businesses like Kim and I, there's something to be said for coming up with the product, but there's more to be said for building it and selling it at, I hate to use these words, a profit. All right, there's a lot of people selling stuff, and I can't figure out how Netflix makes all their money at $15 a month on what I pay them to watch whatever I want. But they found a way to do it. I'm not enough of a businessman to figure out how they're doing it, but they're getting revenue somewhere, and it isn't my subscription.
Well, depending on what you pay, you can have commercials in there, which is where Netflix can make some money and keep the price of the subscription lower, or you can pay for no commercials and
I'm not doing that.
okay, fine.
I need to get my glass of water filled up again.
At that point, then you might as well just watch regular television, but because it's just commercials in there. But I do want to get into this for just a second here. Kristen, when she was with us 2 weeks ago, indicated that, and I think, Jim, you may have been alluding to this, there are other companies that are involved in AI that are not directly AI. She brought up the idea of fiber optics and this sort of thing that these data centers are going to need and use. Is that a good thing to do, to try to find out what companies are affiliated or supporting these AI companies and invest in them?
It is. Diversification is always helpful. And I think what investors have realized over the last year is, of this $600 billion plus that the big tech companies are spending, where is that money going? Someone finally decided to look around and see where the spending is. So that's in energy, power, in the physical infrastructure, the real estate. Obviously, kind of the chips and the compute, the NVIDIAs, that was the first beneficiary. The networking and the software that is used to connect everything together. And then finally, and maybe a little more on the early stage, some of the applications that sit on top of the AI that use the AI. So the nice thing is, I kind of pointed out at the beginning, is a diversified portfolio is going to have exposure to a lot of these secondary areas. Now, if you can be the first to find one of these beneficiaries that's kind of 2 or 3 steps away from NVIDIA, that's where we've seen a lot of profits this year. But, it's not an easy thing to do to get ahead of the crowd as far as that goes.
I agree. And I also think, well, whenever I look at companies that aren't tech, I know it's hard to believe that I do that, but I actually do. I'm looking for companies that use tech well. And I think we can make the assertion that if they're using technology well now, they're probably going to be able to deploy AI. If they're not like super early adopters. And I'm talking about companies like Coca-Cola. Oddly enough, Coca-Cola is in my portfolio because they use technology well, and they're really good at marketing. Like they want to find a drink that you want, right? And they keep doing it over and over. They haven't just created Coca-Cola and off they go. They're not a one product company. But they use technology effectively. And I think that that's probably a good idea for you too, is to keep an eye out for non-tech companies where they use technology well, and kind of make that assumption that over time they're going to probably be able to benefit from AI because they use technology well.
All right. Since you've talked about diversification, is that the best strategy at this point, if indeed you want to be a little on the defensive side, if you think that there's this big bubble that's coming up and it just might go pop at some point?
Well, since you brought it up, an interesting thing is happening right now. And we alluded to it a little bit a couple of weeks ago. But interest rates are rising. Because I've always said interest rates, forget the Fed for the moment, the bond market. Interest rates rise when the demand for money increases. And between government spending and AI spending and war spending, the demand for money is increasing exponentially right now, which means people are, if you want to borrow my money, you're going to have to pay me more to get it because the next guy will. And if that's what's really happening, if all of this stuff slows down, which is what we're kind of alluding to right now, that all of this stuff is going to be really good, it's not going to happen next week. It's going to take years for this to evolve. And when the markets figure out that it's not going to show up in the first quarter of 2027, they might sell some stuff. And when that happens, we might see an economic slowdown, God forbid. They happen every once in a while. And when that happens, you know what usually happens? Interest rates, they fall. So if you buy bonds, 10-year bonds, we'll say, whether it be government or high-quality corporations or good municipal bonds, those bonds will go up in value. So this is a diversifier that protects you against the highly debated bubble theory, fact, whatever it is, that's out there about the market breaking. And in order to protect this, interest rates will come down. And the current president wants that to happen anyway, even though there's no reason to do it at the moment. All right? But that reason could come about with everything else that's going on. A recession in a year or two wouldn't be too shocking. And in the meantime, you'll get 5% in your money while you wait, or more.
Okay, good thought on that. One final point on this, and it was kind of goes back to the first question: is it too late to join the party? When you read those quotes that I just gave, that everybody should be jumping in, everybody should be jumping in. Isn't that sometimes a sign that if everybody goes in, that may be the time to pull back a little bit?
Well, as I pointed out, maybe if if you're the beneficiary of some good stock picks in the past, you should always be risk reducing, which means selling your winners down, not entirely, but I think this is a good rule to follow: is set a percentage. We set around 8%. That anything over that's pretty dangerous. That if a single holding out of all of your stocks or bonds is more than 8%, and something bad happens to it, it's going to show up in your return. So take money off the table, even if it's taxable. And yes, I do care about taxes, but there is a certain point at which you just have to say, well, I've made money, let's take some money off the table and pay taxes. I know.
You're saying, when you're talking about 8%, you're talking about 8% of your portfolio with one particular sector or stock?
Exactly. No,
Yeah.
one particular stock.
Yeah, okay, one particular
Or
stock.
holding. The sector can be as big as, like right now, what is the S&P 500 tech sector? It's approaching 40%, right? It's huge. So, I mean, yeah, don't look at your sectors, look at your individual holdings,
Okay.
and act accordingly. Pare it down.
There's the classic Buffett line, be fearful when others are greedy, and a lot of other quotes along those lines. And I think that's generally a pretty good rule. When you look around and everyone seems to be making money in the stock market, and stocks are, going up 20% on a daily basis, maybe it's time to be a little more cautious on the margins. Obviously it's very difficult to predict the market. I think, after the Big Short, everyone thinks they can predict the next downturn. But if you think about COVID, think about September 11th, those events were completely unpredictable. So we don't know when the market is going to turn, what's going to cause it to turn. But we know it's going to happen, and we know everyone right now is optimistic. Everyone is making money. So, on the margin, I think it makes sense to be a little bit cautious about this market. The last thing you want to do is, chase performance, try to get on after the train has left the station.
That leads me into our last topic I'd like to get into. And there was some interesting economic news. The latest revised GDP report shows a growth of 1.6% for the first quarter. In that number, domestic corporate profits grew 2.7%, and worker compensation, which includes wages and benefits, grew 0.8%. When you translate those numbers into gross domestic income, which according to the article I read is similar but not exactly the same as the GDP, corporate profits year to year surged 12.1%, and that's the largest gain since 1950. However, labor's part of the income dropped to 51%, which is the lowest it's been since 1947, and that's when they started calculating this statistic. In fact, according to Bloomberg, adjusted for inflation, hourly wages are up 3% since the end of 2019, while profits are up 50%. So this may help explain this seemingly growing divide that we have between the glee over the stock market gains and declining consumer confidence in the economy. So, as you guys are investment analysts and advisors, does this sort of comparison carry any weight as far as investing goes?
I don't think so. And here's why. I think these numbers, whenever you were reading them, these numbers speak to me that the winners so far, and probably that we're driving that 12% of earnings, are tech companies, which are notoriously light on humans, right? They have a handful of human beings and lots of machines doing stuff, or they are just incredibly productive and just have very few people. So any kind of wage gains are tilted, or I guess you're comparing the gains from businesses. So if that's heavily tech with very few people, you're not going to see that flow through to benefiting employees because of the low number of people. Does that make sense?
Oh,
If
it
I had
makes
a
sense.
whiteboard, if I only had a whiteboard.
You just had a whiteboard. I guess you could also, when you bring this up, if we're throwing all of businesses in together, the tech companies have seen this huge surge since 2019. Other companies have not, and so you may not, the drill bit company, whatever that might be, or something to that effect, may employ more people, as you're saying, and their profits may not be up as high, but their
Exactly.
workers, are not getting as big of an increase. And tech companies, as you're pointing out, don't utilize the workers as much. Does that make sense, guys?
It does. If nothing else, it tells you that at the moment it's better to be an investor than a worker right now. In these large tech companies, they are monopolistic in many ways. As I mentioned earlier, some of these are winner-take-all markets. So we've created very powerful companies that don't take much labor, although they are becoming more capital intensive with the use of AI. So there's been 100+ year struggle between capital and labor and where the value falls out. I think it's above my pay grade to solve that problem. But for the moment, you look at the dynamics of the market and you can say these are extremely profitable companies in great market positions, and there's a reason that their valuations are so high. Whether you look at Microsoft in operating systems and or Google in search or Facebook in social networking, there are very few competitors for those companies, and that's one of the reasons they're so profitable.
And the other thing you have to factor in as far as the future goes, these companies are creating productivity enhancers. Productivity enhancers will bring inflation down. Right now we have inflation that's getting a little, it's not high, but it's higher than it's been lately. And it's a problem, but it's not a systemic problem, it's an event problem. I mean, we have a waterway shutdown causing problems. We have tariffs causing problems. We have supply issues causing problems. We have weather creating problems in the food industry. So these are creating inflation, and there's nothing that governments can do to affect the weather issues. The other stuff hopefully will get worked out eventually, and the supply chain will begin to work a little more freely, which will create a lot of work for the drill bit guy, because they're going to be doing a lot of drilling to rebuild the Middle East's infrastructure over there, and pipe and whatever else they need to do, that bulldozers and what have you. And and that being said, we've got events creating issues right now that hopefully these events will get solved, will get handled, and those problems will go away, and then the productivity enhancement from technology will become apparent, and prices should level off at that point in time.
Okay. We'll see how it plays out politically, though, in the next election. 'Cause
That's a
those
whole
are
nother
numbers.
can of worms.
Yeah, I was just going to say. It's
That's
a whole
another
other-
show.
That's a completely other podcast.
Yep, exactly. All right. Jim, thank you for joining us, filling in for Michael today. And Kim, always great comments. And Frank, you're our sage here. You really put it into perspective a lot of times. So thanks for joining us. And We will continue our look at investing in the economy in future editions. Also, since you're watching or listening to this podcast, I ask that you hit the like or the subscribe button on whatever platform you happen to use. But for now, thanks for joining us. We'll see you again in probably about 2 weeks or so.